Well, I think what you've seen is two factors driving short-term interest rates up. Number one has been the very short-term concern about whether or not the government can come to an agreement to pay all of its interest on short-term Treasury bills maturing during this period from mid-October to early November. That's been the area where we've seen the most selling and the least buying in short-term Treasuries, where yields have gone up just out of technical concerns about the budget debate. But longer term, I think you're seeing the turning of the interest rate cycle, and the fact that the market is starting to price in down the road some concern about the Fed tapering its QE programs and eventually hiking interest rates. So I think that what you'll see if there's a debt deal is that some of these very, very short-term influences might calm down and short-term yields could come back down a bit. But I think that ultimately they're going to continue to head higher down the road as people realize there's simply no need for the Fed to be as active in its QE program, and therefore interest rates have to rise across the yield curve. Well, 2013 has been a terrible year for fixed income investors all across the board. We've seen mortgage bond prices decline, long-term Treasury bond prices decline, municipal bond prices decline, emerging market bonds, and so on. We've really seen a lot of carnage in the fixed income market. That's why back in 2012, anticipating this, I told our listeners and readers and investors to basically get the heck out of bonds, get out of long-term debt of all stripes, and hide basically in very short-term Treasuries, very short maturity, corporate bonds, and so on, that don't have the price risk of longer-term debt. And that's worked out very well. I think going forward, if we do head into an interest rate hiking cycle for the Fed, despite all their protestations, and we do get in an environment where the credit quality or the ability of the U.S. government to pay its debts is called into question, then you're going to have real problems, and you're going to see a second wave of selling across the board. So I think investors need to avoid still longer-term debt of all kinds, and stay in those very short-term securities, floating rate notes, things that are not subject to the price risk and the risk of price declines that you get when interest rates start to surge. Again, if we go back to past debt ceiling issues, August 2011 being an obvious example, you saw the stock market, the Dow Industrials plunged something like 2,000 points in just a span of a couple of weeks. Now that, and that was accompanied by a big surge in risk spreads across the board and some real panic in the markets. What we've seen so far here is something a lot more muted. Yes, there's been some selling in some assets, but people haven't really been running for the hills, so to speak. And the risk is that that's what happens. If we can't get some kind of deal hammered out, you see a real risk aversion event where bonds sell off in price because of the fears of default. Stocks sell off in price because of fears of default and fears of what it means for the economy. And the U.S. dollar falls sharply as international investors yank their money from the U.S. markets across the board. That's the real nightmare scenario. And that's one thing that I think, is definitely a possibility. And, we need to kind of keep our eyes out for it. For Money in Markets, this is Mike Larson.